Happy Friday, dividend growth stock investors. It's Colby, the DGI Crab. You know what time it is. Time for my favorite video to make of the week, going through each of the four tiers to see where the undervalued stocks lie here at the end of the trading week so we can develop a plan going over the weekend and take a look at what looks good to buy, especially if you're one of those people that does your investing early in the week, like on Monday in the morning. This will give you a lot to go over and consider when you're looking for those bargains. There is so much value to be had out there right now in this supercharged, white hot stock market. And we're going to be going over those values here today. If you watched my video yesterday showing you what I bought this particular week, you probably have a good idea of where I think the value is, but stick around until the end, and we're going to take a look at what's cracking here in this particular week. Now, I'm not a professional financial advisor. The content of the channel should be considered primarily for entertainment, and the opinions expressed regarding investments are my own. You should always perform your own due diligence prior to investing your hard-earned money. For the newbies out there, my strategy is as follows. I put 50% of new money into age-appropriate ETFs for automatic diversification, and I'm looking for stocks that are yielding 30% or more above their 4-year average yield. My top 10 favorite stocks, which is just my personal preference, I will purchase if they're yielding 20% or more above their 4-year average yield because I just love them that much. There's two this week that are in my top 10 that have hit that buy zone category. Just FYI, stick around. I'll go over what those are. Remain in your tier unless there is a stock in a different tier yielding 50% or more above the 4-year average yield. And finally, if there's not a buyable stock within the tier that you happen to be in, then you're going to add more to your ETF. So what are the tiers? Well, what I've done is I've taken 60 high-quality dividend growth stocks, split them into 4 separate categories or tiers based on the age of the investor. Age of the investor, I believe, is the most important metric that a dividend growth stock investor should consider. So tier 1 for the age 18 to 30-year-old investors, where we're looking to get starting yield between 1 and 2% and a growth rate well above 10% each and every year. So that passive income you're acquiring may not generate a lot of income in the early days, but the longer that you hold it and allow it to reinvest, the more it is going to grow and compound over time. If you start out when you're 18 buying stuff like this, by the time you get up into your late 30s, you're going to have a serious dividend snowball on your hands. So Nike remains the only stock within the tier that's above that 30% threshold. I'm looking at the valuation tab where I'm comparing the 4-year average yield to the current day yield and getting the percentage of how far above the current day yield is from the 4-year average. Nordson has been in that buy zone on again, off again over the last couple of months. It's not quite there just yet. I wouldn't fault you if you wanted to continue adding to your Nordson position in addition to this, but certainly Nike remains the top undervalued stock in this category. And then I would be remiss if I didn't just point out, man, United Health Group, their stock has just been plummeting this week with the really tragic news of the CEO just getting murdered in the streets of New York City. I don't have a lot to say about that other than it's a tragedy. Whether the person had a personal vendetta against that CEO for something that he may or may not have done, I don't even know. Murder is terrible. Violence is not the way that we solve our problems. Investing, however, I believe is. Now, United Health's still going to have to fall a little bit more before I think it's a great value, but at 16% undervalued, it's not a bad deal right now, but I think it was pretty overvalued going into the week. So this is, even though it was a tragedy that caused it to happen, I do think a correction was coming due for United Health. So I'm going to wait on this one a little bit more personally. Let me know what you guys think about UNH at these prices. Tier 2 for the 31 to 41-year-old investor, where we're looking to get more like 2 to 3% starting yield with a dividend growth rate in the high single digits. The closer to 10, the better. Hershey and Target are the two stocks in this category that are in the buy zone for right now. Target's recovered a little bit from their massive drop off after missing Q3 earnings a few weeks ago. They got all the way down to $120. They're back up to $132. Still looks like a good deal in my estimation. McCormick continues to flirt with buy zone category, especially after doing their dividend increase recently. Still not quite there yet. I need to get a little bit closer to 75 than in the 77s. Call me a stickler for value, but when you've got, in this category, 19 different stocks to choose from, I think you could be a stickler for value. Still really excited, though, to add Hershey well above 3%. If you've been tracking what I've been doing in my DGI Crab channel portfolio, I've been adding Hershey to it each and every week because this is the tier that I happen to be in. And since it's in that 50% or higher undervalued, this is a great stock for any age to add, in my estimation. Tier 3 for the 42 to 53-year-old investor looking for starting yield or in the 3 to 4% range with a mid to high single-digit dividend growth rate. I want at least 5%, but the higher the better. Archer Daniels Midland at 60% undervalued is such a screaming buy. Earlier this year, when the trouble with their CFO first came out, the stock plummeted from the low 70s all the way down into the low 50s. I was adding at that point in time. And then when it recovered and got back up in the $60 range a few months later, they did a big dividend increase in the middle of all of that. I thought, well, the time to buy Archer Daniels Midland in the low 50s is sadly past. But here they are again, back down at $51, yielding nearly 4%. Absolutely love ADM at these levels. Hormel Foods, in the meantime, also in that buy zone. It's been a bad year for Hormel, but they did continue on their dividend increase streak history. They are now pushing 60 years of consecutive annual dividend increases. They went from $1.13 to $1.16 per share. Not a huge increase, but after the rough year that Hormel's had with their payout ratio creeping up above 70%, I will take the small, conservative, and I think responsible decision by management to do a smaller dividend increase this year. I think that that's encouraging. I think the tides are eventually going to turn for Hormel, and it was nice to see them get up above $32 a share again. They've been down sub 30 at certain points this year also. Genuine Parts, close but not quite at 27% undervalued. I love GPC, great stock. Almost 70 years of annual dividend increases. What a steady Eddie player GPC is. Still want that to get a little bit cheaper, but in the meantime, Pepsi and Johnson & Johnson, denoted here in bold because they are two of my top 10 favorite stocks, both in the 20% or more undervalued range. I added to my Pepsi and J&J positions this week and was very happy to do so. And you got to take advantage of super blue chip companies like these when they look like they're trading cheap. J&J under $150 a share. Are we really that afraid of what RFK Jr. might do to J&J? I mean, that's about the only thing I can find on J&J that seems to have people spooked. One of the greatest stocks out there that you could buy. 3.32% current dividend yield, and they are so consistent growing that dividend year over year, anywhere from 5 to 7% on average. I don't think you can go wrong with J&J. Super steady Eddie. Tier 4, the 54 and older crowd, where we want to get at least a 5% starting yield, but not throw growth totally out the window. If you can still get 2, 3, 4% annual dividend growth year over year to keep up with average years of inflation, that's exactly what you want to do. It's the smallest category among the 4 tiers, only 10 stocks here, and really it still remains just Realty Income is the only one that's even flirting with the possibility of being in the buy zone. I'd like to see Realty Income's current yield get more in that 6% range before I get particularly excited about it. But you could certainly do a lot worse than Realty Income in the $56 range if you're looking to add real estate to your portfolio at this point in time. Realty Income is the bluest of the blue chip real estate stocks, everybody's favorite monthly paying dividend stock, unless you ask me. My favorite one is Main Street Capital, which also pays out monthly. These are the only 2 monthly payers that I have amongst the 60 individual stocks here on the channel. I think they're 1A and 1B pretty much amongst monthly payers, but still looking for the BDC sector to fall a little bit. Maine and Ares Capital are my two BDCs of choice, and they are both fair to maybe somewhat overvalued depending on how you are looking at it. I do keep a separate tab for those top 10 individual stocks. These can all be found somewhere between tiers 1 through 3. I just like to make sure I'm keeping an extra close eye on these particular stocks so I know when they hit that 20%, I can swoop in and buy. Union Pacific, McDonald's, and Coca-Cola are all yielding above their 4-year average yield, but I would still wait for them to get a little bit less expensive before I would start investing any new capital in them, but that's just me. Now, as for the way the strategy would break down, I want to talk ETFs real quickly. This is the same each and every week, you guys. For the tier 1 category, I like the idea of 25% of new money, just dollar cost averaging into the S&P 500, and another 15% going into small cap value stocks. I don't have small cap stuff in those top 60 individual stocks, so you want to get some exposure to that. I do like VIG for dividend appreciation. Not a bad idea to start building up at least a small position there while you're young. And then VYMI is the only non-US investment that I make. I love the Vanguard high dividend yield ETF, 1,500 plus holdings, typically yields above 4%. I really like this one, and it's what I do 5% in across the board, no matter the age. Tier 2, same for ETFs, just a different weighting, 25% dividend appreciation, down to 15 for S&P 500, and 5 for small cap. And then tier 3, these are my 3 favorite higher yielding ETFs that still offer good growth, VYM, SCHD, DHS. 3 very different strategies, 3 different companies that manage them. You could do 45% into one if you like one better than the other 2, but I like the idea of spreading money around a little bit. And then tier 4, we have 8 different ETFs, SPYD for high yield stock exposure, and then we have high yield bonds, preferred shares, MLPs, Devo for covered calls, along with JEPI and SPYI. I am just about ready to call this one JEPQ. As a matter of fact, hey, live on the recording, I'm going to do it. I'm switching this over. Nothing against JEPI, but I've made the decision. JEPQ is the one for me in this category because I'm getting a covered call ETF that tracks the S&P 500 or writes the covered calls on the S&P 500 with SPYI. JEPQ is going to do that with the NASDAQ 100, giving me tech exposure and income at this older age. So I like the idea of having a NASDAQ and an S&P 500 mixed in there together. So I just made the switch live, you guys. JEPQ is in the category now over JEPI. And then for the stocks, for tier 1, look at all these stocks that you can buy. I'd spread the love around personally. Pepsi and Johnson & Johnson, I'd throw a little 5% into each of those. You can start building a small position in these when they're very much on sale. 30% is going to go into Nike, the only undervalued stock in the tier 1 category. And then I do 5% each Hershey and ADM from tier 2 and tier 3 because they're both 50% or more undervalued. For tier 2, and this is what I did this week, I'm going to do 10% into J&J and Pepsi, followed by 15% into Hershey, the most undervalued stock of tier 2. I'm going to give Target a little 5% love, and then Nike and ADM 5% each. For tier 3, I'm doing 15% each into Pepsi and J&J, 10% ADM, 5% Hormel, and I am still going to reach down and do a little 5%er into Hershey. And then finally, I'm doing ETF double down yet again for the tier 4. Instead of 15% and 5s down the board, I'm doing 30% and 10s down the board, keeping VYMI at 5%, and then that extra 5% left over, you could take your pick. Pepsi, J&J, ADM, Hershey, all are going to get you above a 3% yield, good to still add some stuff at this point in time that's going to give you a little bit of dividend growth. All of this stuff is really high yield, so get yourself a little bit of lower yield and growth here while you can. So that is the video for the week, you guys. Let me know what you have been buying. Email me any questions at dgicrab@yahoo.com, and as always, links in the video description below to a video on each of the 4 tiers where I explain how I put each and every stock into those categories. Until next time, keep investing, everyone. I'll see you later.